Gold has for centuries now sheltered people's purchasing power from the depredation by the state. Right now, confidence in the US dollar is fairly high, high enough that you can sell a treasury, a 10-year treasury yielding 4% in a currency that's depreciating by 9% a year. My friend Doug Casey describes the US dollar as, quote, the prettiest mare at the slaughterhouse. But I think that the dollar is only strong relative to other currencies and not absolutely strong. And I say that for several reasons. The first is our bad habit of counterfeiting. The politicians call it quantitative easing. The creation of spurious currency units unbacked by any form of economic growth. The second is more concerning to me, which is, of course, debt and deficits. It's interesting to note that the United States dollar is strong despite the fact that the on-balance sheet liabilities of the federal government now exceed $31 trillion. That's 31 with 12 zeros to keep it company, a mind-boggling number. More mind-boggling is the fact that the Congressional Budget Office, not some fat old bald libertarian named Rick Rule, but rather the Congressional Budget Office, suggests that the off-balance sheet liabilities of the U.S. federal government exceed $120 trillion. What's an off-balance sheet liability? You're looking at one. Medicare, Medicaid, Social Security, all those promises that we as a people have made to each other that we haven't provided the means to pay for. So we have a net present value of $120 trillion in unfunded liabilities on top of on-balance sheet liabilities of $31 trillion. And oh yes, we also have state and local government debts. This whole stack of debt is serviced by a federal government, which is to say taxes and fees less expenses, that is itself in deficit to the tune of about $2 trillion a year. So rather than having the means to amortize or service this debt, we are in fact adding to it. How do we solve this problem? I don't know. And for those reasons, I am doubtful about the maintenance of my purchasing power in instruments around US dollars. But the most concerning thing to me is the fact that I have a government guarantee, the first one in my life that I believe in. The federal government guarantees me that if I buy a US 10-year treasury, that they will pay me 4% a year in a currency that's losing 9% a year in purchasing power, which is to say the government absolutely positively guarantees me that if I loan them money today, they will give me back dramatically less in purchasing power 10 years from now. My friend Jim Grant calls this return-free risk. Return-free risk is not attractive to me. Through centuries, gold has retained its purchasing power as governments have inflated away the purchasing power of honest workers. And for that reason, I continue to believe in gold. It's interesting that I myself own a reasonably large amount of gold, despite the fact that a reasonable financial planner might say that I should own none as a consequence of my very large shareholdings, as an example, in Sprott and my ownership of gold stocks. But I own gold anyway. Ironically, despite saying all of this to you, I personally would prefer the gold price to go down. I personally would prefer all of the things I'm afraid of not coming to pass. I regard gold as insurance. And I don't want to get paid on this insurance policy anytime soon. It's like a life insurance policy in that regard. I'm happy to have the insurance, but I don't want to collect the prize. In fact, were the gold price to rise from its current level, 1650 or whatever it is, to 2200 or 2300, I probably wouldn't sell any if the underlying conditions hadn't changed. By contrast, if the gold price were to fall from 1650 to 1500, I'd probably buy a lot, which means it's in my interest probably to see the gold price lower rather than higher, because as I say, I regard it as an insurance asset. I start building a gold portfolio by owning gold. Now, you can own it physically, which I do, or you can buy some of the high-quality exchange-traded pieces of paper. If you want to get away from gold as an insurance class and look at gold as an investment class, then you buy the biggest and the best of the gold equities. It could be said that the easiest way to play gold, once again, is to play the beta, which is to say buy the physical gold and then buy one of the ETFs. My preference would be, of course, that you bought one of the Sprott ETFs. But the truth is that the whole waterfront of ETFs, if you buy ETFs around the biggest and the best producers, will give you access to the beta in the gold markets without having to do the work that would be incumbent on you if you were going to invest in individual companies.
What are your views on silver?
They say silver is a poor man's gold. I like silver as a speculation, and I'm going to begin to build my silver hoard now because so many people don't like it. It's disappointed them so much that it's unpopular. And I always like to be lonely. What I've noticed about silver is it's much more volatile than gold, but it's a late cycle mover. Gold has to create the momentum in the market. Gold has to manifest the saver's uncertainty. When that happens, perhaps because of its lower unit cost, silver is a late cycle mover, but when it begins to move, it moves further and faster than gold. And probably the most volatile of the natural resource investments that I know of are the higher quality silver equities. There simply is not enough market capitalization in the silver equity space to accommodate the inflow of generalist capital that happens during precious metals bull markets. My friend Doug Casey described the result as trying to siphon Hoover Dam through a garden hose. Fairly good-sized companies can yield 500 or 600 or 700% price moves in very short periods of time, 2 or 3 years. But the time that you have to wait for the unleashing of that sort of latent energy and the amount of volatility that you have to endure until it begins can be unnerving. I happen to have very strong nerves, so the speculative part of me, which is a big part of me, enjoys silver, but in particular enjoys the silver equities. My definition, and you'll read a very different one on Wikipedia, my definition of an investor is someone who deploys capital in the rational expectation of adequate returns of capital employed, given a range of economic circumstances that he or she sees as a probability. So understand that the probabilities have to be on your side, the time frames have to be reasonable, and your return expectations have to be reasonable. This is what Warren Buffett does for a living, oh so well. The speculator is someone who is looking for above average returns, but is willing to accept that the outcome is a possibility rather than a probability. In other words, taking more risk, accepting more uncertainty, but as a consequence demanding higher returns. For about 40 years, I have suggested to people that they invest, that they build a base before they speculate. I, of course, did exactly the wrong thing. All of the money that I made, which enabled me to invest sensibly, came from speculating, occasionally fairly recklessly. But I got very lucky and I worked very hard. So I would suggest that most people invest before they speculate, and then only speculate with the amount of money that they have both the intestinal fortitude and the financial staying power to consider to be a